Well, let's talk about the markets now. To understand the market thinking on the war requires an understanding that markets are cold-hearted. The fact that negotiations broke down over the weekend is important, but it's not the dominant input for markets. Crude fell for the second straight day to test a low of about $90 a barrel. Not too long ago, crude was threatening to break through above $120, and before this war, crude was meandering between $60 and $70 per barrel. Now, analysts at the International Energy Agency have pointed out that the supply hit is still not fully reflected in prices. The latest crude moves suggest an end to the war is near. Wall Street stocks ended Tuesday with gains despite prevailing the geopolitical risks. The S&P 500 is trading close to its late January peak. The tech-heavy Nasdaq 100 extended its winning streak to a 10th day, which is the longest since 2021. Asian stocks mirrored those gains, with the world's second-best performer, Korea, leading the way. Indian benchmark soared over 1.6% to reflect global optimism and the IMF's solid growth projection for the country. In the middle of the war, the S&P 500 is about to hit a new all-time high. When the war started, remember, the S&P 500 had crashed 8.5%, wiping out $5.3 trillion in market value. Now, from the 31st of March low, the benchmark is up almost 10%, adding $6.2 trillion back. And the strangest thing is that the war is still not over. Negotiations have failed. The U.S. blockade of Iranian ports is active, yet S&P 500 is just 1% away from a new all-time high. Wall Street moves suggest the bigger and longer-term picture is more palatable. From a coal market mindset, even if Israel and Iran were to lob munitions at each other, markets will not care. Markets will care if the U.S. is in the game and ramping up risk. Now, it seems that the U.S. prefers an off-ramp. However, things could change quickly in the coming few days. While headlines offer little reason for optimism, remember, markets seem to take more of a wait-and-see approach rather than assuming what will happen next. If anything, the glass is still half full when looking at risk assets. But the strong performance of risk assets stands in contrast to the still elevated oil prices and rates, which raises questions about the consistency in market pricing. Higher energy costs and monetary policy tightening should be a drag on growth and negative for stocks. For consumers, the prices of almost everything, including at the pump, have surged, but markets seem willing to look through all of this.